There's so much going on with central banks that we don't know. The Bank for International Settlements now, the BIS in Switzerland. Now, they determined a few years ago that gold held by banks can be counted as a tier one asset. In other words, it has
Yeah.
no risk. Officially, gold has no risk. In the US now, that didn't take effect, but it will take effect, I think, on July 1st. And so then it will be a tier one asset for US banks. They can hold gold and not have any reserves against it. That's a big advantage. It's much better than having treasuries. So I would assume that that will increase the demand of gold.
The Bank for International Settlements, BIS, through the Basel III framework, has indeed reclassified gold as a Tier 1 asset, specifically for physical, allocated gold held in a bank's vault. This change, effective July 1, 2025, is a significant shift, recognizing gold's high-quality liquid asset HQLA status and treating it similarly to cash and government bonds. Once in place, U.S. banks can hold gold without needing to reserve capital against it, making it more attractive than even U.S. Treasuries. This change is expected to boost institutional demand for gold. Before Basel III, gold was often treated as a Tier 3 asset with a 50% risk weighting. The reclassification to Tier 1 with a zero risk weighting means that banks can now hold gold in their reserves without the previous limitations. Bert Dohmen is a veteran market analyst, trader, and founder of Dohmen Capital Research. He explains that the U.S. may be approaching a critical financial tipping point, which some argue began in 1971, when President Nixon ended the dollar's convertibility into gold. This move, seen by many as a default on America's promise, raises questions, especially since there was no apparent public reason to close the gold window at that time. Some speculate Nixon did it because the U.S. gold reserves, possibly in Fort Knox, were already depleted. Despite claims by officials that the gold is accounted for and regularly audited, figures like Congressman Ron Paul have long pushed unsuccessfully for a formal audit. Recent record gold imports into the U.S. raise further suspicion, perhaps an attempt to restock reserves in anticipation of scrutiny. Bert reflects on starting his business in 1977 during a time of high inflation and recalls sharing contrarian views with Ray Dalio at financial conferences. He points out that concerns about excessive U.S. debt are nothing new. It has been growing for decades. What once sparked alarm over a few $billion in debt now barely raises eyebrows, even as deficits balloon into the trillions. Most people, he notes, don't even grasp the true magnitude of $1 trillion. Despite claims of monetary tightening, U.S. money supply is at a record high, indicating the Fed isn't truly tightening. Rising interest rates don't always mean tighter money. They can also signal inflation, which often leads to rising stock prices as companies pass on costs. In the 1980s, the Fed claimed to stop printing money, but the unadjusted money supply soared, proving otherwise. Today, he warns that stock market rallies and IPO hype are designed to lure the public in before a downturn. Smart money is selling, distribution, and the public risks becoming bag holders. He urges caution and sees gold and silver as safer alternatives amid manipulation and economic uncertainty. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
Basically defaulted on a debt by making the US dollar not convertible into gold. That was when Nixon closed the gold window, 1971. Why did he do that? I can only guess because that was a really daring move. There was no reason to public knowledge for him to do such a risky move, to suddenly say we were not going to give you gold anymore for dollars, although we had promised you that we would. So my question is that why would he do that? Why would he take such a risk at a time when there was no need to do it? Is it maybe that he found out there was no more gold in Fort Knox? Could that be the reason? Why does the new U.S. Treasury Secretary, he's on record, he told reporters, he said, oh, all the gold is there. I saw. There's no record of him ever going to Fort Knox. Then he said, it's audited every year. No, it is not. I know Ron Paul very well, Congress, and he tried to get it audited since at least 1978. So there's possibly no there there. So you have to consider that. Now, we have record imports over the last year of gold into the United States. Is that maybe an effort to put some gold? I think this is a scare story. I started my business in 1977. Okay, and the first part, that was when we had the double-digit inflation, etc. In fact, I was on many panels with Ray Dalio at the time. He had a financial newsletter he published out of his apartment in New York. So obviously, he's a lot smarter than me because he got to be a multi-billionaire with his hedge fund that he started later. But Ray and I, we had beers together during that time and so on. And we usually had the contrarian opinion at the conference. But I've heard that argument, excessive debt. Our debt is, yes, it's terrible, but it's going to keep on growing. Because I remember when we complained, this was maybe 40 years ago, about adding another $2 or $3 billion to the federal debt, $1 billion to the federal debt. Now we're talking about $1 trillion. People don't even know. You ask the average person, do you know how much a trillion is? The average person doesn't know how much a trillion is. Money supply right now, the last numbers that they published was at a new record. I just broke out to a new rate. Money supply, and the Fed tells us they're tight. No, they're not tight. You know, see, the definition of tight money is totally wrong. Everybody says, or seems to say, that rising interest rates tell you that the Fed is tight. No, there are two distinctly different reasons for interest rates rising. Okay. And I pointed out in 1978, when the Fed chairman in 1978 said, we're not going to fight inflation with tight money, we're going to do it with interest rate policy. And I said, okay, that means rising interest rates. That means inflation full speed ahead. And that means stocks will rise. And there was a Wall Street economist for Goldman Sachs, Gary Wenglowski. He said, that is absurd. He had a seminar in my city, and I went to it. He said, oh, rising interest rates cannot lead to rising stock prices. I said, yes, it can, because stocks will become an inflation hedge. Companies can raise prices as inflation goes up, and therefore it becomes an inflation hedge. And the stock market did rise while our interest rates went double digits. And my forecast of a 20% prime rate actually came through in 1980 with 20% prime rate in early 1980. Then the Federal Reserve stepped on the accelerator temporarily and said, but I looked at the unadjusted money supply number because they also publish seasonally adjusted money supply and then the real money supply. And the real money supply I looked at unadjusted, and it was soaring. At the same time that the Federal Reserve said, no, we stopped the printing of money. No, it was soaring. So they were lying. Okay, that was in June of 1980. Okay, and I said by year end, we're going to have a new high in the prime rate. It's going to be over 20%. On December 10th in 1980, we had a prime rate of 21.5%. So that's how you can stay ahead of the people who are trying to pull the wool over our eyes. There always are. Whatever comes out of Washington, you can be sure it's false. Well, I think right now the old saying that we used a long time ago is there are times when the person who loses the least is the person who makes the most. So you don't want to lose money. And forget all this talk about, oh, here's a great stock and wonderful stock, and oh, wow, it's going to go to sky high and so on. All these all the IPOs, these big gains in the IPOs right now, these are manipulated in order to whet the speculative appetite of the public. That's it. Lure them into the market at the top. I've been saying for the last couple of months, said this rally is going to go until one of the major indices, at least long enough so financial TV can celebrate and pop the champagne corks and say, oh, we made a new record high, and everybody. So these are usually bull traps, okay? And you want to be very careful. I have seen now over the last several weeks many signs of distribution. Distribution is when the big smart money sells the stock positions to the public, okay? Because they don't want to hold the stocks all the way down. Somebody has to own a stock on the way down in the bear market, but they don't want to do it. So they get the public to do that. The public becomes the bag holder. Joe Granville used to call them that, the bag holders. So we are all elected to be bag holders. So you got to find a way not to be a bag holder. So precious metals now, gold and silver, are a great alternative.
After World War II ended in May 1945, Germany was left using Hitler's Reichsmark, which no one trusted. For a while, there was no valuable currency in circulation until the Allies introduced a new one, later replaced by the German mark around 1950. During the interim, people relied on silver coins, especially the well-known Maria Theresa thalers, as a form of real money. These coins could buy essential goods, often through backdoor deals, while paper money was virtually worthless. The speaker recalls how children even played with hyperinflated currency from the 1920s. Notes originally marked as millions, later rubber-stamped into billions, highlighting how extreme inflation rendered money useless. Bert Dohmen points out that Americans often lack perspective on economic collapse and war, because such devastation hasn't occurred on U.S. soil since the Civil War. In contrast, many people from other countries, especially in Europe, have lived through wars, hyperinflation, and hardship, gaining profound lessons from those experiences. The speaker recalls how, during Germany's hyperinflation in the 1920s, wealthy Americans could purchase luxury hotels with just bags of gold coins because the local currency had become worthless. As a child in post-war Europe, he scavenged through rubble for valuable metals like zinc, copper, and even platinum-tipped lightning rods, selling them for money. These harsh times taught powerful, lasting lessons about survival, value, and resilience. Now, let's shift our attention towards the interview.
There was the war ended in May 1945. And so the only currency in circulation was the Reichsmark, which was Hitler's currency. And of course, nobody wanted that when the war was over, but it's the only thing we had. So the Allies finally came out with their own allied currency, and later on, that was replaced by the German mark. That was, I think, around 1950. But so there was a period when there was really no money in circulation that people wanted. They would take it, but you wouldn't get the stuff that you really wanted. If you had something that people wanted, like silver coins, they would take you into the back room. And that's where the groceries were that you really wanted to buy. And at the time, my parents still had a lot of the thalers, they were called Thaler, Maria Theresian thaler. And that was a very well-known silver coin issued by the Hungarian Austrian Empire. And so everybody knew the content. And that was the desired medium of exchange. My parents had that, and that allowed them to buy food and the things that they wanted for us kids. And it was really amazing how, with paper money you couldn't get anything. And but that also reminded me of a time because as kids were playing during the war years
Yes.
with currency that my parents had from the German hyperinflation, which was in 1921. And they had notes, currency notes that had written 1 million marks, okay? And it was rubber stamped on top of it, 1 milliard, which was a billion marks, rubber stamp. They couldn't print fast enough, although the government confiscated all printing presses just to print currencies, but it still wasn't enough to print all the paper money that they needed. So they used rubber stamps to change the value of each currency note. Can you imagine that? My parents had a lot of it. We kids played with that money because it's never happened in the United States. Americans have a big disadvantage over other people. Other people in other countries, most of them have experienced devastating wars. The United States has not had a devastating war on its soil. The last war was the Civil War, and that really war teaches you a lot. Bad times teach you many bigger things. The Depression, people who lived through the Depression in the U.S. and was worldwide, in fact, they learned so much. And I remember my parents talking about 1921, the hyperinflation, the smart, wealthier Americans. They came over with bags full of American gold coins, and like the $20 piece and so on. And with a few silver coins, they were buying up the biggest luxury hotels in Germany, like in Berlin and so on. Can you imagine buying a big, beautiful hotel just with a little bag full of gold coins? Because money was worth nothing. The owners of the hotels could not afford to pay the employees to buy the food, etc. So those are tough times. You learn a lot during times like this. And I was a little kid at that time, but boy, did we learn! And my memories
Wow.
are so clear of that time. We went
Wow.
through the rubble of houses. Like my father's city was totally destroyed, most destroyed city in Europe, 94% flat. And I remember walking over this pile of rubble as far as you could see. And he said, and right underneath where we are is the main street of the city. So you couldn't see any street. Yeah, so that's how it was. And so we would go as kids, we would go through all the destroyed houses and so on and try to find metal, zinc, for example. The gutters were made out of zinc. Then the big price was always the lightning rods in houses. They had tips of platinum for conductivity. And boy, if you found one of those, that was a lot of money. So we take it to the scrap dealer, and the dealer, of course, would always cheat us, but because we didn't really know how much it was worth. But we made a lot of money as kids. Just finding metals, copper from the wreckages, the zinc from the wreckages, etc. And it really teaches you so much about life.
Bert Dohmen's observations illustrate how monetary manipulation, policy changes, and historical events shape the economic risks and opportunities of today. Concerns over market traps, money supply distortions, and U.S. debt become more pertinent with gold's new Tier 1 status under Basel III. In the face of growing mistrust in fiat systems, his firsthand experiences, from post-war Europe to high-inflation America, highlight the lasting importance of tangible assets like gold and silver. People must be alert and take prudent precautions against systemic danger as central banks realign and sensible money withdraws from inflated markets. How might the financial system change if U.S. banks were permitted to retain gold without having to meet reserve requirements? Do recent gold imports into the United States raise more serious questions regarding the reliability of the country's reserves? Please leave a remark below with your thoughts. If you found this video helpful, please give it a thumbs up and subscribe to receive our latest updates.